Hello and welcome to Claros. I'm Scott Wilderman, Chief Human, and today we're going to talk a little bit about core satellite investing, which has become widely accepted as a method for building strong portfolios. We're going to take a high-level approach, so here's a link that will take you to a number of places for those who would like to do additional research. Core satellite portfolio construction is not a new concept, and traditionally the core portion has been made up of passive funds, meaning not trying to pick winners, but simply using indexes to follow the market. So they're benchmarked to composites like the S&P 500, NASDAQ 100, Russell 2000, international and emerging market indexes for equities, or various bond indexes, and what have you. The purpose was always to try to provide diversification using various asset allocation strategies. The problem is that under certain circumstances or at various times, it may not allow you to protect yourself. For example, some of the most common equity indexes are heavily influenced by just a few very large companies that drive the entire index. So we often find that we're not as diversified as we may think when we invest in major market indexes. Another potential problem with pure passive investing is that even if you are diversified, it doesn't give you protection against a major market-wide drawdown. And a good example of this is what we saw in the late summer and early fall of 2008. So the result is a lot of industry professionals have started to call into question the validity of pure indexing in your core, and many people have been looking for alternatives ever since. At Claros, we've had a different philosophy towards building your core. We believe that hard real estate assets and real estate ETFs, along with other investments that provide a portfolio that is based on generating income, provide a stronger, more resilient core. The big idea is to generate strong income with possible asset appreciation, but to make sure that the income stream is independent of fluctuations in the value of the underlying assets. So even if the prices move up and down from time to time, which we wouldn't expect to happen very often or very much, or they wouldn't be part of our core, what we have is a more stable core that's driven by income. That way, the returns we generate are compoundable, and we'll talk more about compounding in the next video in our series. A core-worthy investment has three qualities, actually requirements, that we look for. First, they have to be sticky, meaning the price action moves slowly. So let's make sure we understand that. By price action, we're talking about the amount that prices swing up and down and the rate at which they move up and down. So what we're talking about is volatility, and we don't like volatility, we like sticky. Secondly, the returns have to be predictable. We can't sit around waiting, wondering, worrying whether or not the investment is going to throw off income, or how much income it's going to generate, or when it's going to generate that income. Finally, it needs to be understandable. If you need a master's degree in finance, then it's not what we're looking for. You need to be able to say, I know what it is, I know how it works, and I know how I make money. Satellite investments have a different purpose. What we want to do with them is give ourselves the opportunity to try to add alpha, which is a financial term for exceeding the returns that are going to be provided by the broad-based market and the major indexes. So we use particular vehicles like individual stocks, actively managed funds, investments that are focused on particular sectors, and even separate asset managers. And we're going to use these particular vehicles to focus on things like economic sectors, oil and gas, consumer discretionary, financials, or technology, and what have you. And we'll also be looking at geographic regions, the US, Europe, Asia, or emerging markets. And even just the size of the company, small companies, mid-sized companies, large companies, or even the mega-cap companies you hear so much about in the news. Of course, satellite investing can come with some side effects, so depending on whether your assets are held in retirement or non-retirement accounts, or both, you should definitely talk to your Claros advisor about whether or not satellite investing is appropriate for you. Satellite investments also have three characteristics that we look for. First, they have to be fluid, meaning the prices move in a trend that we can see. So although the price action may be faster than in our core investments, the wave analogy is pretty good. We know where the wave starts, we know how it starts, we can see how it's going to move, and we know where it's going to end up, on the beach. Secondly, it has to be liquid. We can't be stuck in a satellite investment when we want to get out, and we can't be prevented from getting in when we see that the time and price is right. So there has to be lots of buyers and sellers providing a liquid exchange for the investment. It's not that we're going to trade these things daily, it's just that on the days we want to get in or out, we have to be able to do that efficiently. And finally, they have to be repeatable. So understanding the trend and utilizing the liquidity, we have to believe that we're going to be able to repeat the results over time. So in summary, the core satellite strategy allows us the flexibility to blend styles and choose investments that are appropriate for each client's goals and risk tolerance. The core investments provide a solid foundation, and the satellites allow us to participate where we want, when we want. Overall, we have a portfolio that provides stable returns and the opportunity to outperform. So when it's all put together, this is what a core satellite portfolio looks like. We have a certain number of investments in our core and a certain number of satellites, and there's nothing magical about the number. There has to be 5 of each here. But we're going to determine what is in the best interest of each client in terms of what percent they should have in their core and what percent they should have in their satellites. And altogether, it's going to be a complete portfolio suited to the client's goals, plans, and risk level. So thanks for watching, and we hope you'll watch part 2 in our series called Compounding Returns.